Hello, everyone, and welcome to the 8th episode of the Multifamily Methods Real Estate Podcast. I'm your host, James Gleason, and thank you for joining. Today, I'm going to get into what is my criteria, what is my buy box when I am looking for deals. What are the methods that I'm using in 2026 to find my deals, whether it's on market or off market. If you've been listening to this show, or if you've just heard my content on social media, you've heard me say a lot that your ability to find deals in this real estate business is your highest dollar per hour activity as a real estate investor, point blank. Real estate is an incredible business, probably the best business in the world for wealth creation. You can create a lot of equity and net worth through real estate. You can create passive income as well. It is a little bit more difficult in 2026 than it used to be when I got started. But if you invest in the right markets, investing for cash flow is still absolutely possible, especially as you hold that real estate long term. And your rents increase as your mortgage remains the same. Having cash flow becomes even more doable. But really the most powerful part about real estate is the wealth creation. And if you want to get to that wealth creation as quickly as possible, you got to get really good at finding deals. So there's a lot of, different strategies and kind of mindsets that I want to talk about today that have helped me become successful in my real estate investing journey. Just a few quick things that I'm seeing in the market. I'm recording this July 11th of 2026. I've definitely noticed that here in St. Louis, particularly in the city, the market's a little bit slower. I have quite a few listings in the city right now. I think I have something like 6 or 7 listings in the city. They do not sell after one day of being listed, like my flips in, Chesterfield and Manchester did. If you're listening to this nationally, if you're not in Missouri, basically, the more affordable real estate in the city, it's taking a longer time for that to sell than in nicer parts of town. The rental market has still been pretty active in my experience. My management team was at over a 96% physical occupancy rate. And then recently this month, we took over another 86 units, and that dropped us down to right about 92%. But we'll get that above 95% pretty quickly again. By the way, I think it would be useful information for people to know kind of what KPI metrics we are shooting for in my management company. So to go over those really quick, one of the things that we want to see is a 95% occupancy rate, and more importantly, a 95% economic occupancy rate. And so most people pay attention to physical occupancy, which is just of your total units, how many people are actually living in those units rather than it being vacant. Economic occupancy is of all of the rent that you should be collecting in your portfolio, how much rent are you collecting? So it's not only how many tenants are living in your units, but how many tenants are actually paying rent. Because, obviously if you have a tenant who's living in one of your properties and they're not actually paying you rent, it's not doing you that much good. So we pay attention to economic occupancy. We pay attention to our delinquency rate. Basically, we want those collections to be above 97%. But really, every tenant who's not paying their rent ultimately gets evicted in our portfolio. If they haven't paid rent by the 15th and they haven't communicated, we're evicting them. If they have communicated, but they're kind of giving us the runaround, we'll work with them until the 30th. And then If it's the 10th of the following month, if they make a partial payment, so we don't evict them on the 30th, if it's the 10th of the following month and they owe us at least 1 month of rent or more, then we're also filing that eviction. So delinquency rate, something we're looking at. Our move in to move out ratio, we want that to be 110%. So we want to be moving in 10% more residents than are moving out. If that is below 100%, you're going to have a vacancy issue because you're having more people moving out than moving in. I love looking at that metric because it helps you understand, number one, if you're leasing, if your turns are going quickly, but also if your tenant retention is good. You know, if you have more people moving out than what you can keep in your properties, that is going to be a problem. So these are all things we're looking at. Maintenance. We want all of our maintenance requests to be completed within 72 hours. Sometimes this is not realistic. We have some maintenance requests right now where an HVAC system needs to be replaced and it's under warranty. And so we're waiting on the vendor to replace a part that's under warranty, and that's taking a very long time. Any emergencies, if it has to do with HVAC, if it has to do with water, if it has to do with the safety of the resident, we are getting on that much more quickly than if a closet door isn't opening or a window isn't opening or something like that. That's more so preference, but also just functionality of something that's not really safety or if it's habitable or not. But those are some of the metrics we're looking at in my property management company. The rental market is doing reasonably well. My more affordable listings are filling up a little bit more quickly. My B-class and A-class assets are taking a little bit longer to fill up, but those are still filling up nonetheless. They're just taking a little bit longer. You know, my C-class assets, I can usually fill those up within a couple of weeks. The B and A-class assets, it's taking right about 30 days, sometimes even a little bit longer than that if we're trying to get market rate rents. So the rental market is a little bit slower. The apartment market, I've noticed in particular, is a little bit slower. I have tried to list my 40 unit and my 28 unit this year, and both are just taking a little bit longer to sell. And so we've taken both of those off of the market and we're waiting to see what happens. That mainly has to do with interest rates. Interest rates are higher than they were during the COVID era. You had a lot of investors who bought real estate during the COVID era because those interest rates were so low. And so they were able to afford more real estate, more apartment, more bang for their buck because their purchasing power was higher because those interest rates were lower. So now that interest rates are higher and those values have come down a little bit, you see a discrepancy between what the seller thinks their apartment is worth and what the buyer is willing to pay. And so I have some apartment buildings that I had this idea of what I'd be able to sell it for, and people are just not quite budging on those prices right now. So luckily, I own cash flowing real estate. I have other businesses that produce income. I am in no rush to sell these assets. So I am fine taking these off of the market, waiting a little bit and seeing if, there's a better time to sell those in the future if interest rates do come down. Obviously, if, I was in a pinch, it would not be good. That's why you never want to put yourself in a pinch. You always want to have that liquidity. You always want to buy right. You always want to make sure that your assets are cash flowing so that you can sell when you want. Why am I selling those assets? Well, I have a lot of equity. One of them, my 28 unit, my partners are in a different stage of life than I am. They're hitting retirement age. I just turned 30, and so I still have a lot of growth to do over the next 50 years or so. Whereas my partners for the 28 unit, they're in their 60s. They don't really care about long-term wealth anymore. They care more about, capturing that equity, getting that cash, and just, moving on with their life. So different stages of life. That is something to be cognizant of, when you're partnering with people. Those who know my story know that I have made a fortune through partnerships. A big part of my success in real estate has been from my ability to partner with other investors. And in many cases, the structure has been something like I'm the subject matter expert, the partner has some money, and so I'm usually finding the deal, I'm doing the construction management, and I have the relationship with the lenders. I basically bring that deal, I find the deal and bring it from A to Z, and my partner brings the money, and we'll have, a 50-50 split or something like that. That's typically how I've done my partnerships. And, looking back, I think it's for anyone listening to this, if you are going to partner with someone, it's really important to think about what stage of life that investor is in. If they're a lot older than you, and if you're listening to this and you're younger like I was, I got started when I was 21 years old. Most people in real estate with hundreds of thousands of dollars saved, or millions for that matter, they're going to be older than you. Most of the time, these people are not going to be in their 20s, or even, in a lot of cases, not even in their 30s, but definitely not in their 20s. So, you have to reach out to people who are older than you. Do not let age be a factor. I know I certainly didn't. You can make up for that with your competence, with your work ethic. I've never had someone not give me money because of my age. I've been able to prove myself in terms of my expertise, my knowledge in real estate, my professionalism, my ability to operate in construction management and property management, my ability to underwrite, just being able to do real estate. And so I don't think anyone who's ever invested with me has even considered my age as a setback. So if you're listening to this and you're younger, that certainly doesn't need to be a setback for you. I know people in real estate who are younger than I am who are absolutely crushing it. So don't let that hold you back. But certainly, pay attention to what stage of life your partners are in. When me and my partners first ended up buying this 28 unit, the plan that we all talked about was to hold on to this asset long term. And now, it's been about 3 years and they're in their 60s and they're like, you know what, I'd rather sell. I don't really want to deal with apartments anymore, and I kind of just want the money and I want to live off of that. And that's totally fine. So that's what we're going to do. I plan on taking that equity and reinvesting it, maybe keeping a little bit in savings, but I plan on being productive with the entire thing. I certainly don't plan on just squandering it, because it's going to be several hundreds of thousands of dollars from that sale. And with interest rates being a little higher, we ended up taking that off the market. We will see if we end up selling that anytime soon. I don't think we're going to sell that this year. I think at the very least, it's going to be 2027. I read something interesting the other day, speaking of 2027. If you're listening to this and you want to get into multifamily investing, you want to get into apartment investing, and you're just thinking to yourself, what is the best time? Like, is 2026 really a good market to be investing in apartment deals? So I would say, first of all, for the right deal, it's always the right time to be investing in apartment deals. It's not when you should invest in real estate, it's where. There are always opportunities. There's always going to be cash flowing real estate, especially if you're looking in the Midwest. The other thing is there's certainly less competition right now than there was when interest rates were lower, during the COVID era, for example. Interest rates decreases purchasing power. And so if you have a good direct to seller deal, you can negotiate with seller finance, with creative finance. You can maybe you can negotiate more. Maybe you can move a little bit more on price. There's not 5 other people bidding for the same real estate. So in that respect, even if the interest rates are higher and your cost of financing is higher, you can get a better deal in this market than you were able to during COVID. And then you could always refinance sometime in the future if interest rates do eventually come down. But in terms of timing, one thing that you could look at for multifamily that is a very good predictor of rental demand. Real estate is all about supply and demand, just like every single other anything in this economy. Any business, anything that needs to be sold, anything that needs to be bought, it's all about supply and demand. And real estate is the exact same thing. You can look at the permits for developers in real estate nationally. This is public record. Whenever someone is looking to develop an apartment building, they pull a permit for this to break ground. There's usually about a 2 or 3 year timeline from the time that they pull that permit to the time that the property is actually completed. And they're looking for tenants. They're marketing for residents to live in this apartment building. And when interest rates were artificially low during the COVID era, there were all sorts of permits that were pulled to develop real estate because the cost of building was so low. We didn't quite have as much inflation as we do today, and interest rates were a lot lower. So it was a lot easier to make a deal pencil out on paper than it was when interest rates increased. And then we all know what happened after that. After the COVID era, interest rates increased. And so 3 years from the time that interest rates increased is the time that, those new developers are going to be looking for their residents. Well, if you look at the permits that were pulled 3 years prior to 2027, so in 2024, the amount of those permits really drops like a hockey stick. And so the idea is you had a lot of developers who have been developing 2024, 2025, 2026, but in 2027, 2028, the amount of new housing units that are coming to market really starts to decrease pretty substantially. And so if you own apartment units, that is a great time to rent your property because there's less supply of housing. And if demand remains the same, you have less competition. And so the cost of rents increase. And so that's the idea of 2027 and 2028 for apartment investing, is that it's going to be a great time in terms of rents. And that demand is really going to increase as the supply starts to sort of decrease. This is one of the beautiful things of real estate, is that you're really in an advantage regardless of if, interest rates are high or interest rates are low. If interest rates are low, purchasing power increases. And so there's a lot more demand for buying houses. And so in theory, the cost of housing increases. But if interest rates increase, then purchasing power decreases. And so demand for housing decreases and housing becomes more unaffordable. Well, you only have 3 options. You can buy a house, you can rent a house, or you can be homeless. So if people can't afford to buy houses, they have to rent. And so when interest rates are higher, more people have to rent, demand for rental properties increase. And so even if your purchase price isn't increasing, your rents can still increase. And so it's really a double whammy here. Depending on where interest rates are and where the demand is, your purchase price can be increasing or the demand for rents can be increasing. And so you're benefiting regardless if you hold on to this real estate long term. I do think trying to time the market is not a good idea. You should always be looking for deals. You should always be investing in real estate. No one can time the market. We all know this. But at the same time, it is certainly important to pay attention to interest rates and what the Fed is doing, especially if you already own that real estate, and especially as you get into apartment investing. Because if there's an opportunity to refinance your real estate, especially if you can keep your amortization schedule the same, you should do it. So, for example, if I own an apartment building, and let's say I've owned the real estate for 5 years, so that's on a 20-year amortization in most cases if you're working with a commercial bank, and I own that real estate for 5 years, and let's say interest rates come down. A lot of people, a lot of smart investors wouldn't want to refinance that real estate because it can reschedule your amortization schedule, restart your amortization schedule. So you can be right back to a 20-year amortization. Yeah, your payment went down, but now at the exact moment that you're starting to pay a little bit more principal, right? You're 5 years into this amortization. You've now restarted that, and you're now back to paying the vast majority of your mortgage towards interest. Well, so instead of just restarting your amortization, you should just do a 15-year note when you refinance that property, and now you're on the same amortization schedule. You still are going to pay off that real estate in 15 years, and you've decreased your payment. So it's important to know what's happening with rates because you'll know what type of financing to use. So, for example, right now a lot of my real estate is in what's called prime floating debt. And so what that means is that as the Fed funds rate adjusts, so does the interest rate on my mortgage property, because commercial rates most of the time follow what's known as prime, which is 3 points above the Fed funds rate. I believe that interest rates are going to come down this year. The market believes that interest rates are going to go up. I don't think that that is an affordable path for the US government and for the Fed. And so I think that the Fed is bluffing. I think that eventually, as unemployment gets worse, and I do think unemployment is going to get worse. I think the economy is not going to do well. I think AI is going to take away jobs, which is going to exacerbate the issue as AI continues to replace jobs and robotics continues to replace jobs. So I think unemployment is going to get worse. And so when the Fed is in between two positions, inflation becoming worse, which would result in an increase in interest rates, or unemployment getting worse and the economy getting worse, which would result in a decrease of interest rates, I think that the more politically viable option would be to decrease interest rates. We've already seen the Fed do nothing or close to nothing as inflation data gets worse. It's pretty much unprecedented, however, if the economy gets worse and people are losing their jobs, and the stock market's crashing, real estate's crashing, everything's crashing, it's very unlikely for the Fed to do nothing about that and not decrease interest rates. And so I think regardless of what the market thinks and regardless of what Kevin Warsh is saying about interest rates, I believe that interest rates are ultimately going to decrease this year, if not early next year. And so as a result of that, I think the smartest thing to do for my financing right now is prime floating, because when those rates decrease, I get a direct benefit of that. Whereas if I was in a 3-year or 5-year fixed rate debt for that commercial financing, as interest rates come down, I would not get the benefit for that because my interest rate would be fixed. So it's very important to be aware of these things. However, even if you are aware of them, even if you are up to date on the economy and the Fed, in terms of actually buying real estate, if you're purchasing, number one, cash flowing real estate, number two, if you have ample reserves in the bank, so ideally 5 to 10% of your debt, and if you're purchasing in the right markets, if you're purchasing in linear markets rather than exponential markets, so markets like the Midwest that have a very boring 3 to 5% appreciation rate, then it's almost always a good time to buy real estate as long as you're finding a good deal. You never want to be reckless. You never want to spend too much for your real estate unless the terms are really good. There are a few times that I'm willing to overpay for my real estate, if I'm getting, a seller carryback, for example, or really good seller financing terms, or an example like that where I'm getting terms that make sense for me, then I'm willing to overpay. I'd also say I'm sort of willing to overpay in that I'm willing to be a little bit more aggressive than the guy next to me for the sake of getting that real estate deal, because over the long term, the $5,000 or $10,000 that I quote unquote overspend for that real estate is not going to matter when that asset has essentially doubled in value over the next 10 to 15 years. And so I'm always thinking about the long term for my portfolio in my real estate. And therefore, it's okay that I overpay slightly to get that asset. And over the past 3 years, when interest rates have been a little bit higher and the competition has been lower, while the vast majority of investors have been sitting on the sidelines waiting for those interest rates to decrease, I have still been very active. In fact, the most active I've ever been was last year, when a lot of investors, were saying that interest rates were too high. And so you really want to be the investor who goes against what everyone else is saying, right? If everyone else is saying it's a great time to buy, to me, that's a great time to sell, right? So if interest rates come down again, everyone's going to say this is a great time to buy real estate. That's probably going to be the time where I'm more willing to sell my real estate because I'll be able to get top dollar. Right now, people are saying now is not really a good time to buy real estate. And so I'm buying real estate because there's less competition. So I started this podcast by saying that I wanted to get into my buying criteria, how I find deals on market, off market, the relationships that I build. I'm actually going to save that for the next episode because today I went off on a tangent a little bit. I talked about if 2026 is a good year to invest, some of the metrics that I'm looking at, my thesis for inflation in the long term, and what I think is going to happen to multifamily real estate in 2027 and 2028, and kind of, if I time the market or not, and how I think about buying real estate over the long term. So I hope that this was good information. I hope that you found it valuable, and I hope that this helps you all when you're thinking about investing in real estate and when you're thinking about the market and the economy and how it all plays in. I hope that this was valuable. So thank you everyone for tuning in to the 8th episode of the Multifamily Methods Real Estate Podcast. We'll see you on the next episode.